It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to Your Personal Bank Show. And, as we're getting closer to Christmas, I thought, what would be some good things to cover? Because I know a lot of folks who are interested, have questions, things like that about the Your Personal Bank concept. There's a lot of uncertainty going forward in our economy, those stock markets, of course, have been at all-time highs recently, and things are, inflation's kicking in more and more. The Federal Reserve, Chairman Powell, has stated that inflation is no longer transitory, which means it's going to be with us for a while. He claims it'll disappear somehow by magic in mid-2022. Of course, he was also the one that said it would be transitory, so I don't know if we believe him. And inflation, again, is one of those things that's it's a lot easier to prevent than it is. An ounce of prevention is far better than a pound of cure. So we'll see, but I have a hard time believing it's just going to disappear that quickly, particularly if we have a government that continues to spend the kind of money it's spending, and who knows what else it's going to spend, right? Particularly over this next year or so. There's just a lot of uncertainty out there. A lot of people are concerned. They want to know what to do with their money. How do I protect myself? Taxes, we haven't even gotten there yet in terms of what's going to happen in terms of the tax codes and stuff next year. Nobody really knows. There's a lot of talk about increasing all kinds of different taxes, yet little has happened so far. So we're not sure, you know what I mean? It's uncertain. But, obviously taxes certainly can go up. And the spending, debt levels at all-time highs. Inflation is here. It's going to be here for a while. What do you do? How do you protect yourself? And I've stated over and over again that Your Personal Bank happens to be one of the best tools you can use to offset inflation. Also, one of the best tools you can use to reduce taxes. And lastly, you can create positive arbitrage, which means your money goes farther. You have more money. I'll explain that a little bit further here. My point is, and also, great diversification strategy. In other words, if you're concerned about the markets going forward, what's going to happen, and you want to diversify, Your Personal Bank can be a great solution in a non-correlated asset. Okay? Which means it's something that has nothing to do with the other investments that you have. Diversification is a great strategy to offset risk. So my point is, what I find interesting is a lot of the people that reach out to me and they contact me, and by the way, you can reach me at toll-free 866-268-4422 or yourpersonalbank.com if you have any further questions. But I'm going to answer some recent emails I've gotten from various folks here. But it is definitely a tool that I believe you should look into. If you fail to do so, or you have some preconceived notions about how your personal bank, how a high cash value policy combined with a bank line of credit can enhance your finances, you're doing yourself a real disservice. And I don't. That's the nicest way I can put it. And if there was ever a time to look for a different strategy, a diversification strategy, one that could reduce taxes, offset inflation, reduce market risk, create positive arbitrage, in my career, I can't think of a better time. And that spans over 22 years now. So, it's funny when people reach out to me and talk to me, as I was starting to say, is I rarely have to get, talking to a gentleman today, in fact, perfect example. He's an engineer. He's been listening to the station for quite a while, listening to the show, Your Personal Bank Show, and I appreciate it. And he goes, I get it. He goes, I've looked into this, I've researched it, I've listened to your show, I checked out your website at yourpersonalbank.com, got some more information. What do I need to do to get started? Because he goes, I understand I can diversify, I can reduce my taxes, I can reduce my market risk, I can offset inflation with a highly interest rate sensitive asset, and I can create positive arbitrage. He says, it's a no-brainer. I said, that's how most of my clients or folks that reach out to me, once they understand how this really works, I hear that constantly. that, yeah, this just makes total sense. It's a no-brainer. Folks, it's not that complicated. In fact, I'll share with you in less than a minute probably here. I'll take about a minute to share with you how this process, how this concept works. So if somebody's trying to tell you it's complicated, they don't know what they're talking about. The bottom line is this. We set up a high cash value policy designed to grow cash value, not death benefit. This is not the type of policy most people have ever seen or are familiar with. We structurally and fundamentally change a policy to maximize cash growth, unlike anything else you've probably ever seen or familiar with, like I said earlier. We have companies who have been paying up to 6% dividends for the last 25 plus years, have never missed a dividend since literally before the Civil War. These are serious, long-term, A-plus rated companies with billions of dollars in cash reserves, well-positioned to continue paying those dividends out, frankly, some of them out for the rest of your lifetimes, okay? Then the second step is we set up a bank line of credit using the cash in the policy as the collateral for the loan. And the beauty of this is it's a fully collateralized loan. This is the easiest loan you've ever applied for. The application is super simple. As long as you don't have any, I get these questions all the time. As long as you don't have any judgments or liens, you're probably going to be qualified, okay? And when you decide to, so if you put the funds in the policy to earn the dividends, again, you're going to earn up to 6% dividends, depending on which company we work with. You leave it there, it's going to grow dividends. Plain and simple. With guarantees, tax-free, diversification, all that good stuff. Then when you decide to access the money, for whatever reason, you access it through the bank line of credit. We have banks charging between 3 and 3.95%. And when you access those monies, you take them from the bank, not the insurance company. So therefore, the money's still in the insurance policy, earning the dividends every year, compound for the rest of your life. The money you access and use, you can spend however you want. No penalties, no taxes, nothing. It's your money. Do whatever you want. You get charged less than you're earning. You keep the difference. That's the positive arbitrage. And the difference for most clients that I work with is 2.5% to 3%. And by the way, historically, over the last 40 years, I've got documentation to show this from the companies that the positive arbitrage has historically been there. In fact, one of the companies showed where it was there every single month for the last 40 years, except for 2 months that happened to be equal in those 2 months. In other words, you had positive arbitrage every year for the last 40 years, except for every month of the last 40 years, except for 2 months. That's how it works, folks. I took about a minute. That's it. That's the concept. That's how it works. You can do anything you want with that money. So if you leave it there, like I said, if you just want to park it somewhere for a while, you can do that. And you can earn some dividends and get some tax breaks. You're going to actually get some grow the money tax-free, period, no matter what you do with it. If you set it up right, like we do. But then again, the real power comes into play is when you actually use those dollars and allocate them for other things, like purchasing items, paying down debt, or investing those monies into another asset. Whatever you use the money for, you're either reducing the cost of borrowing, wiping out interest costs, in other words. You're offsetting, or if you're purchasing items, you're offsetting the lost opportunity cost. In other words, when you trade dollars for an item, you've lost the ability of those dollars to earn for you going forward. That's called lost opportunity cost. Here you gain some of that back, so your money can still earn for you, even though you took the money and bought a car with it, for example, or whatever you did. I have folks that buy all kinds of things. Cars, houses, and everything in between, okay? Small things, big things, you name it. Doesn't matter. Or you take the money and you invest it in something and increase your rate of return by 2-3% annually, every year, rest of your life, with guarantees, tax-free. 2-3% for some people doesn't sound like a lot, but investors understand this. You can increase your rate of return by, in many cases, 20-30% or more. What do I mean by that? Well, if you're making a 7% return on your money and now you're making 10, you just increased your rate of return by 30%. Run a compound interest calculator at 7% versus 10%. Compound that over a decade or 2 or 3 and look at the difference. The differences are massive. Okay? So it's a massive increase in your rate of return. That's why it's so important to look into this. That's why it's so important to see where this will enhance your financial situation. It will it'll increase your rate of return. So how could that not enhance your financial situation, right? Positive arbitrage just means you're going to have more money in your pocket, more money available every year increasing for the rest of your life. If you understand positive arbitrage, you understand this is a no-brainer. Because that's what people say to me all the time. Why wouldn't I do this? Because I'll just have more money. I said, exactly. Perfect example of a business owner client of mine talked to like 2 days ago. So he's been putting money into his policy to maximize the cash growth, right? The dividends. Now, he hasn't taken any money from it yet because he hasn't needed it. But he has a large expense coming up. And it's a $10,000 expense. And he said, look, I got the 10 grand. I'm going to have to pay this bill, this expense, but I don't need to pay it for another month or two. What if I funded it into the policy, then accessed it through the bank line of credit, and in his case, he'll pick up 2.5% positive arbitrage, and then take that money and pay the bill? I said, why not? Absolutely. Because here's the thing. His choice is he's got to pay this bill, right? He's got this expense. He's going to pay the 10 grand, no matter what. But the difference is here, by putting in the policy and then accessing it through the bank line, he's going to pick up 2.5% interest on that every year for the rest of his life. This gentleman happens to be in his mid-40s. How long is he going to live? He's a former professional athlete. He's very healthy. He's going to be around a while. Let's just say he lives another 40 years. You do realize that just the interest on the positive arbitrage means he'll not get only the 10 grand back in interest, but probably 2 or 3 times that. In other words, he's either going to take the 10 grand and pay the bill, pay the expense, right? Or buy the item or invest the money or whatever it is you do with that 10 grand. And if he does that, it's gone forever, right? If he pays that bill, I asked him, I said, if you take that 10 grand and pay the bill, will you ever see that money ever again the rest of your life? He's like, no. Will that money ever earn any interest for you ever again for the rest of your life? Of course, the answer is no. And see, that's how most Americans operate. They don't operate nearly as efficiently with their money as they could. Far, far less efficiently than they could. Here's the difference. I said, look, like you said, put in the policy. Earn the dividends. Then access it through the bank line. Pay the bill. Keep the positive arbitrage on that 10 grand every year the rest of your life. And in your lifetime, depending on how long you live, you'll get somewhere probably between $20,000 and $30,000 of interest back in your pocket throughout the rest of your life. Which would you rather have? Stay tuned in the next segments. I'm going to talk about some common questions that people ask me. So I recommend don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. Today we're covering some of the most common... Well, I'm going to start covering some of the common questions that come about because, again, the show's airing... We're nearing Christmas. And, a lot of people are looking into this. As I said, if you're concerned about, inflation, you should be. It's here. It's here to stay. According to Jerome Powell, head of the Federal Reserve, even concerned about the markets. Inflation typically is not great for stock markets. Some market risk. Concerned about taxes. The current administration frequently talks about increasing taxes on all kinds of different ways. So having a tax-free bucket of money certainly makes sense. Diversification and a non-correlated asset makes a lot of sense. Again, it's very logical. It's very straightforward. Very simple. And if you missed how this works, go to yourpersonalbank.com. The first segment I explained in about 2 minutes, less than 2 minutes, how it worked, and use some examples I think that were very good. Very good, actually. It was a very good segment. If you missed it, I think most would agree. So what are some of the questions I get on this all the time? Let me do it this way. I'm going to do it a little bit backwards. And what I mean by that is I'll cover a few of the questions on the bank line side first, because generally speaking, those are easier. And the reason I think they're easier is quite simple, is because far more people have experience with a loan from a bank than they do working with an insurance company. In other words, the insurance side of it isn't so much that it's a bad thing or a negative thing or anything all like that. It's just an unfamiliar thing. when I say it's a paradigm shift in thinking about your money, is it is because so few people have experience with working with an insurance company from an investment standpoint. Yet they're one of the original, they are the original investment companies and some of the best. They have benefits that are unique, particularly the tax-free aspects, non-correlated assets, creating a non-correlated asset class, one with guarantees, certainly. And again, the ability to create positive arbitrage. These are unique benefits, unique things that are just not offered in any other asset class. And sadly, to the detriment of most people, they've never even entertained or considered or were introduced really genuinely to the idea. Somebody, in most cases, what I find is most people just never looked into it or anything. Or if they did, it was very casually, or it was or they talked to somebody who had little or no experience or knowledge with this themselves. Most financial advisors don't. In fact, most insurance agents don't have experience with your personal bank concept. They have experience with, say, dealing with IULs, Index Universal Life, or annuities, typically, things like that, using those as an investment vehicle. And those have some strengths and weaknesses, just like every other investment tool out there. I'm not going to get into all that right now. I have other shows that get into the pluses and minuses of those products. And, if you want to check it out, go to yourpersonalbank.com. You can listen to any of the previously recorded shows. Each has a topic. So you'll see I've devoted entire shows to annuities, to Index Universal Life, all these different things, because I've dealt with these for over 20 years myself as an agent. So what people don't have experience with is using the two together, the bank line with the high cash value policy. In other words, many of those quote-unquote insurance investment tools, the IULs and stuff, can indeed have growth, but oftentimes are inhibited, let's say, quite a bit, because they're not structured correctly in terms of maximizing cash growth. They often carry far too much death benefit, for example, to enable them to create a maximized tool to grow cash. And it's interesting how, and this is one of the questions I get, it's so often I run into folks who have had a policy or looked into one. And then we run head-to-head comparison numbers, and they're shocked by how much more cash I'm able to show them. Typically, on average, folks, it's 20-30% more each and every year. Every year the rest of their lives. You compound that out, it's a heck of a lot more money in most cases, right? They're shocked by that, and they start asking the question, how can you do that? I say, well, it just wasn't structured as well as it could have been, okay? In most cases. Or you didn't have the best product, the best tool, or whatever. Or it wasn't, like I said, it wasn't structured the best way. So if you have one of these policies, which is one of the questions I get, or you looked into it, yeah, I deal with them all the time. We can do a head-to-head comparison, no cost or obligation. And if it does, and I'll show you the numbers. I mean, it's not me telling you this. This is what's so cool about these kind of comparison situations. I love them because you don't have to believe me or anybody else for that matter. It's the numbers. We take the numbers from the actuarial numbers from each company. This is the best estimates each company has on what they think this product's going to do. And folks, these are highly regulated and highly accurate. Very accurate, okay? So they're the most accurate numbers you can get. And we compare the two. And it becomes, as I put it often, abundantly obvious what you should do. Usually within about 5 or 10 minutes. I'll give you an example of a situation not too long ago where I had a guy who he had done this type of thing where he said, his mentor had told him, look, who was highly successful, said, you need to set up one of these high cash value policies to maximize cash growth, tax-free, with guarantees. All that sounded great to him, so he did. He set one up. And he funded it for a year or two. And I explained to him where, asked him which company he worked with and things like that. And I said, we can do way better. He goes, yeah, everybody says that. And I said, no. I said, put me to the test. I said, challenge me. Let's run the numbers. I'm 99% certain we can beat this and beat it by a good shot. It took a little convincing. He's okay, fine. What do you say? Look, you got nothing to lose. We run numbers, right? Compare. One phone call. He called, contacts the company, asks for an in-force policy illustration is what it's called. And he emailed it to me, and I ran some numbers, and I called him back, said, hey, set up a time to get together. I said, you're going to like what we came up with. And he goes, yeah, everybody says that. No, you're really going to like them. Okay, fine. He did. We sat down. Now, this was before COVID, okay? So we sat down. I do it over the computer most of the time these days. Even folks that are local, by the way. Makes it a lot more convenient for everybody. But if you want to meet in person, that's fine, too, either way. I'm in Phoenix area. But anyway. So we look at the two numbers, we compare them. I mean, it wasn't even 2 minutes. Showed him the numbers. Here's what you have. Here's what it's going to look like in year 5, 10, 20, so on, right? Here's what we came up with. Same numbers, same funding, same everything. And it was like, in his case, it was all upwards of 50% more money each and every single year. It was one of the bigger, I told you most times 20, 30% more, but this one was even bigger than that. He literally looked at me. He says, how do I get rid of this piece of garbage, the one he had? So here's a guy. Of course, we were able to do a 1035 exchange, which is a non-taxable event. We move the money. It's a lot like a rollover, if you will. Non-taxable, move the money over, kicked it in, money grow faster. And, he was way better off, obviously, each and every year, the rest of his life. But here's a guy who was very, very skeptical, very hesitant, and within 2 minutes was like, how do I switch now? Just by looking at the numbers. So a comparison situation is super duper easy. If you already have one of these or you're considering them, contact me at yourpersonalbank.com or toll free 866-268-4422. Let's run a comparison. Let's run the numbers, and I'll show you what I mean, what I'm talking about, and you'll see how much better what we're doing is. Plus, we can bring in the bank lines with the positive arbitrage, which I would almost bet anything on that you don't get that now currently. So stay tuned to the next segment. We're going to cover some other commonly asked questions, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. Today we're talking about commonly asked questions that come up with your personal bank concept, how it works, and all that stuff. And like I said in the first segment, I covered real straightforward, very briefly, how it worked. And if you missed that, go to yourpersonalbank.com. You can listen to any of the previously recorded shows. There's topics on each one. And gosh, there's a couple of years of shows there available. So there's tons of content, just so you know. But, if you want to look at offset inflation or reduce taxes or reduce market risk or create positive arbitrage, you really need to look into Your Personal Bank. And as I said, I was starting to get into it, and the last segment I was talking about replacing or comparison or replacing. On the bank line side, I said that's the easier question because most people have some familiarity with lines of credit or HELOCs, home equity lines of credit, or mortgages or whatever. And the bottom line is, when you take a mortgage or a HELOC or a bank line against a property, for example, most people understand this. The collateral for the loan is the property, the asset itself, right? So, if you don't pay the bank, they're going to take the house, right? Most people get that. And so you make the monthly payment, right? Well, the collateral for the loan here is the policy, the cash in the policy. But this is even better because, first of all, to qualify, super easy. This is a fully collateralized loan. Okay, since it's just cash, they're not going to take your policy. They'll just take the cash from it if you don't pay them. So they know they're going to get paid, and it's a lot easier than the banks prefer this. It's a lot easier. It's liquid cash. It's asset. Much easier than a property, because if they do have to foreclose, there's costs involved, and the asset, the value of the house can vary, and all kinds of things, right? So that's why banks don't really want the house. They don't really want to foreclose. But when you talk about accessing cash from a policy, that's a piece of cake. So fully collateralized loan. In fact, if you don't want it to, you get the choice. You can either put it on your credit. This is often a question. Does it go on my credit score? And the option's yours. You can put it. You can list it on your credit score, or have the bank list it on if you want to improve your credit, or not. If you're actively doing, because I have a lot of real estate investors who are actively doing real estate investment deals on a regular basis, and they don't want to have it hit their credit score, right? So they just report it as they set it up as a business line, and it doesn't get reported. The bank doesn't report it. So really cool. It's super easy to qualify for. Simplest app you've ever done. Again, unless you have a judgment or lien, you're probably going to get qualified. I haven't had anybody turn down yet. We'll put it that way. Super duper easy. The interest that they're charging historically is less than the dividends the companies are paying. That's why you get the positive arbitrage. That's why it works. In the first segment I even shared where I have documentation showing the last 40 years with one of the companies every single month, one of the companies we work with, the positive arbitrage has been there every single month except for 2 months in the last 40 years. And in fact, those 2 months had happened to be equal, so you weren't getting hurt. So my point is, as long as you get any positive arbitrage, in other words, you're earning more than you're getting charged. You're earning more than you're getting charged when you're using it. It's positive cash flow. Most people get positive cash flow. It means more money, right? If you can get your money to create a positive cash flow, positive interest, and you're using it elsewhere, that's a no-brainer. Because now your money's actually earning twice for you, isn't it? Because if you take it and invest it in something and get whatever return you get, and you add the positive arbitrage, the extra interest returns, the difference what you get to keep, what you're getting paid and what you're getting charged, you're making more money. Folks, it's mathematical. It's not complicated, right? You know, a person making 9.5% versus somebody making, if you have a 7% return asset, and now you're making 9.5 on average or 10, you're going to have more money, right? It's not really that complicated. So the line of credit side is pretty easy. The banks, if a bank, I've had a few questions. What if the bank went, these are FDIC insured banks and all this kind of good stuff. There's no 1099s issued. There's no taxable event occurs, all that kind of stuff. So, and if one bank's rates change or something, we have multiple banks we work with. We just switch it to one of the other banks. And you can do, all of them are free. There's no cost to set up the loans. No appraisal fees, no points, nothing. Okay, so in fact, where there's different tiers of, I always say the banks are charging between 3 and 3.95 right now, depending on the size of the account. Oftentimes we have people start with one bank, and then as they build enough cash up to hit the next tier, where another bank offers a lower rate, then we switch. We do it all the time. We usually say, hey, it's time for you to switch, and here's the new app. So you fill it out, and boom. Even if you already have a loan, doesn't matter. You don't have to pay it back. Then the new bank just takes it over. Okay? So it's, again, super simple. That's another common question I get. Yeah, it's no problem. Use the money, access the funds, use them as you see fit, and then when you get higher tiers, lower rates, we just switch. And at no cost to you, and it's seamless is what I'm trying to say. And by the way, the access to the funds, that's probably one of the last questions I get. Heck, these banks will send you a checkbook, folks. It's as easy as you literally can write a check or go online and do an online bill pay. If you've ever had a checking account, it's that simple. So stay tuned in the next segment. I'm going to cover some common questions, particularly on the high cash value insurance side, which the side folks are less familiar with typically, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. We're talking about commonly asked questions with Your Personal Bank. And if you missed any of the previous part of this show, go to yourpersonalbank.com. You can listen to this or any of the other previously recorded shows anytime you like. Pass it on. Tons of content there. Like I said, there's a couple of years worth of shows there. So each has its own topic. So check it out, yourpersonalbank.com. So the part that I get the most questions on typically involves the insurance side of it. Again, we're setting up a high cash value policy to maximize dividends. And then we set up a bank line to access the funds through, using the cash on the policy as collateral. To access the funds, get positive arbitrage, so you make more on your money. And the reason I believe that I get far more questions on the insurance side than the bank side, because again, we use the two together, that the combination of the two, marrying the two together is what makes it so powerful and so rare. There's so few people out there doing this. It's not that I'm the only one, but gosh, I'm the only one I think I've ever met. I'll put it that way. I'll take that back, couple. But very, very rare. And it's because I do have the background. If you know anything, listen to the show for any period of time or listen to whatever, I've got the financial background. I'm an entrepreneur, got the financial background and the banking background. I'm on the board of a bank, that kind of thing. So my point is simple, is when you put all this together, it's really powerful. That positive arbitrage means you have more money. your money makes more, right? It works double time for you, so to speak. So, but people are less familiar with the insurance side because so few folks, the average, well, I'll put it this way, what Wall Street calls the average retail investor, so few of them have really used any insurance tool as an investment. It's far more common in the institutional world. And what I mean by that is like bank boards. We deal with this on a regular basis. Very common. Corporate finance boards, family offices, and those are typically defined as folks who have 10 million liquid or more, and that's kind of a rough rule of thumb for what's considered an institutional investor too. They use it on a regular basis because when you mention tax-free, you got their attention because most of those kind of folks and entities have high income, high tax bills, right? So it's a very commonly used tool in that arena. But in the retail world, the average investor, it's just not. And you got to think of this as an asset class just like any other. And that's what it is. It's an asset class. I've been to events where they talk about cash value insurance as an asset class. I have to laugh because I've been teaching that for years. It was a new idea for most of the event. This was just an event I was at a few years ago, and it was about a year before COVID actually, and it was so funny. So many of the advisors were there, and this was a new concept to them. And I was like, I've been teaching this for like close to a decade already. Anyway, the point I'm making is it's an asset class. The idea is you're putting your money in a policy to earn dividends, much like any other dividend asset, whether it's a dividend-paying stock or a bond or anything like that. It has some unique aspects and benefits. Like I said, there's guarantees involved. You can grow the money, access it, and pass it on to yours tax-free if you set it up right. So that's quite unique. It's got some other benefits where you have a long-term care and death benefit involved that's oftentimes at little or minimal cost, frankly, especially the way we structure them. The way we structure policies, we're cutting the death benefits and such by 50 to 85% day one, and every year. So right off the gate, we're cutting the cost of insurance by 50 to 85%. It would be similar to you going to an advisor or a mutual fund company or whatever, a REIT or whatever it may be, and you say to them, hey, I understand you guys have some fees on your products. Would you be willing to cut those in half or even by 85%? And I think most of us know what the answer would be if you asked that question. But yet that's what we're doing. By how we structurally change, by adding specific riders that are free, we structurally change these policies, and we're literally cutting the cost of insurance, the fees, everything by 50 to 85%. What that does is it really truly grows the cash, maximizes the cash growth, and maximizes dividends, which is the goal. We want to maximize the growth on the money. And as I've stated earlier so many times, we have companies paying upwards of 5.75 to 6% dividends for the last 25 plus years and never missed a dividend since before the Civil War. I mean, these are the granddaddy of all dividend payers. And that's why I kind of have to laugh when people kind of look at this with a skeptical eye or a view or sometimes. And I kind of laugh and I'm like, this is the granddaddy of them all. Why are you questioning this? Frankly, you should be questioning a lot of the stuff you're invested in right now when I look at their portfolio. Because these are companies that have been paying, if you're looking for that, paying dividends are far, far less long, right? A period of time, and much less in many cases, and oftentimes taxable. And you're questioning this when this is like, again, this is like, it's from an experience level and strength, financial strength level and all that kind of thing. It's like questioning the experience of the grandfather versus a teenager, okay? And they're invested with the teenager, right? And I'm thinking to myself, why are you questioning this? It's been around but it's new to them. I get. So a lot of times when people ask me those questions or they meet with me, this is new to you or it's new to them. But once I help them understand the financial strength, the consistency, the stability, the history, A+ rated, all that kind of good stuff, it just kind of really settles a lot of that down. Access to the funds, again, a lot of the questions that the The limitations, if somebody's dealt with any insurance products as an asset, trying to grow cash out of them, again, you've probably had experience where you didn't have it structured properly to maximize cash. So it didn't go do as good as you thought it would or what you were told. And I stated that in the first segment because I run into that all the time. We do comparisons all the time. In most cases, we're showing 20, 30% on average, by the way. That's the average. More cash each and every year. That's a big difference. Sometimes it's like a lot of times people look at a policy and they'll say, well, it takes, one of the common things is it takes 10 or 15 years to grow the cash. And again, in a traditional policy, the way they're structured traditionally, that's true. We're not doing that. In fact, most of the time, we're fully liquid with folks anywhere from about 4 to 7 years, to give you an idea. In other words, 100% of the money you put in, you could take out within 4 to 7 years. Guaranteed. Tax-free. I mean, that's just normal, okay? Sometimes it takes a little longer. Depends on age and health and things like that. But, that's normal, okay? And another difference we see quite often is a lot of times folks are familiar with setting up an insurance policy to grow cash, and they'll notice their cash values in the first year are quite limited. Sometimes they're even zero. Well, I see that a lot, by the way. I've seen situations where there's zero cash for 3 or 4 years, first 3 or 4 years even, before it starts to grow any cash. And then, year 10, 15, 20, it starts really looking good, but not the first few years. And when I show them the numbers, again, 50 to 85% cash day one. I mean, 50% to 85% cash day one over zero, that's a huge, massive difference, right? So again, that gives you a practical, very straightforward explanation of the difference that you see on the insurance side on what we do. And of course, that's important because then you can access that cash through the bank line and create the positive arbitrage and use that money for other purposes and earn more interest on it, right? That's our goal. We're not trying to... And so it's funny. Most of the questions I get, it's funny, are revolve around the death benefit. And I have to remind people sometimes, well, let me ask you a question. You keep asking me questions about death benefit, but are you trying to maximize death benefit here or you want to maximize cash? Because frankly, death benefit is of secondary importance to us in most cases. We're setting this up to earn dividends. Yeah, there's a small death benefit involved. That's part of how you get the tax-free benefits going forward and all that, which is nice. And that's there as a secondary, emergency thing. If you, offset, loss of future income or something like that, something happened to you prematurely, okay, yeah, that's fine. But it's very much a secondary consideration in most cases for most of my clients, okay? So when they started, I said the cost of insurance and things like that, again, I addressed that earlier already in this segment. If we're reducing the insurance by 50 to 85%, right out the gate, we're cutting the costs by 50 to 85%. We're cutting the fees. We're cutting the commissions. We're cutting all of those things. In other words, I take a pay cut when I set these up. I make if I cut it by 50 to 85%, I take a 50 to 85% reduction of commission. That's how all policies work, folks. That's how the financial advisor, insurance agents get paid. And I'm not saying this is the motivation, but sometimes it is, of why you haven't been shown a policy that really will maximize cash growth. A lot of people, when I explain that, that answers a lot of questions, or that explains a lot. I said, exactly. Think about it. If every case I'm doing, which is true, I'm cutting my commissions by half or more every single time, right out the gate. But it's giving you that much more cash, right? Who wins? You, the client. And that's the purpose. That's the goal. Now, to be fair, I'm not picking on other advisors or anything like that. I've been fortunate in that I've found a method of explaining and sharing this idea and concept with a lot of people, obviously on the radio, right? I'm told, let's put it this way. Well, over 100,000 people between the different, each and every week are listening. I've been told it can be upwards of 250,000, by the way, weekly, between all the different media sources that this show goes out to right now. So I've got quite an audience of folks to educate. And so you can listen to this. You can go, like I say, you can go to yourpersonalbank.com on our website and listen to previously recorded shows to gain more information. So most of the time when somebody contacts me, they've got a pretty good handle on how all this works. I don't have to spend a lot of time educating, do I? If I had to sit down and spend an hour or two with each and every person every time I dealt with a client, you could understand. I only have so many hours in the day, just like anyone else. I would have to charge more. I'd have to charge fees or something, right? Which is what most financial advisors do. Unfortunately, I don't have to do that. I found a cost-effective method. Previously, with speaking engagements, I used to travel the country and speak to investor groups where I'd speak to anywhere from typically 30 to 150 people at a time. And now the audience is far bigger, right? And by the way, since I'm on that subject, I failed to mention this many times, but we are looking for a sponsor to take this to additional cities, this show. So if you know somebody that'd be interested in sponsoring this, it would be particular about, we've got a couple of great sponsors. We just want to be very particular. We want to add one or two more. But to bring us to additional markets, additional cities, please have them contact me, yourpersonalbank.com, or toll free 866-268-4422. We want to spread the message, educate more people about how you really can enhance your financial future using a tool that, frankly, most people have not thought about. But it really does. It really gives you the opportunity to diversify in a non-correlated asset. As I've said so many times, it's so important now. It's more important than ever to offset inflation, because inflation is here to stay, according to the Federal Reserve. And offset market risk, I think that's getting to be more important than ever. We've had a tremendous market, no question, over the last decade or so. But with the Federal Reserve pulling out, tapering, and not supporting the market by buying $80 billion of bonds every month, which certainly supports the market, with them pulling out of that over the next several months, certainly is going to have some kind of impact on the markets, okay? We're seeing some of those things, okay? So diversification, reducing market risk, reducing taxes. Gosh, the current administration, how many times have they been talking about raising taxes, right? And creating positive arbitrage, keeping the difference when you use your money, which means you earn more money, you get more interest, you keep the difference, which means your money goes farther. And with inflation and taxes, that's also very important. For more information, contact me at toll-free 866-268-4422 or yourpersonalbank.com for more information. And as always, stay tuned to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.